1. Business quality and economic moat. Business model. Snap Inc. operates as a technology company focused on visual communication through its flagship product, Snapchat. The platform enables users to share short-form videos and images. Augmented by AR features, messaging, and content discovery tools, revenue is primarily generated through advertising products, for example, sponsored snaps, AR ads, and subscriptions, Snapchat Plus. Competitive advantages and economic moat. User engagement. Snapchat has 932 million monthly active users, MAUs, and 469 million daily active users, DAUs, with DAUs growing 9% YoY. High engagement is driven by features like Spotlight short-form video and AR lenses used 8 billion times daily. Augmented reality leadership. Snap leads in AR innovation with over 4 million lenses created on its platform and plans to launch consumer AR glasses specs in 2026. This vertical integration from developer tools to hardware is a differentiator. Advertising ecosystem. Sponsored snaps drive significant advertiser ROI, for example, 22% increase in conversions. Other revenue, mainly Snapchat Plus, grew 64% YoY to $171 million in Q2 2025. Weaknesses, despite user growth. North America MAUs were flat YoY and competition from TikTok, Meta, and YouTube remains intense. The company lacks a durable economic moat due to low switching costs and advertiser dependence. Moat assessment. Narrow based on AR innovation and user engagement, but limited pricing power and high competition. 2. Management quality leadership and capital allocation. CEO Evan Spiegel has focused on long-term bets like AR and AI, though profitability remains elusive. Management prioritized user growth over short-term financial results. Capital allocation. Snap repurchased 30 million shares, $243 million, in Q2 2025. However, R&D spending remains high. $654 million in adjusted operating expenses in Q2, and net losses persist. Shareholder alignment. Insider ownership is not disclosed. But management's focus on speculative investments, for example, specs may not align with value creation.
Assessment.
Innovation efforts are notable, but poor capital allocation, prioritizing growth over profitability, and lack of transparency are concerns. 3. Financial strength, revenue, and profitability. Revenue, $5.64 billion TTM, with Q2 2025 revenue up 9%, YoY to $1.34 billion. Profitability. Net loss of $263 million in Q2 2025, wider than $249 million. YoY TTM net loss is $546.3 million. Margins. Gross margin is strong, approximately 53.8% TTM. But operating margin is minus 11.6% due to high R&D and sales costs. Cash flow. Operating cash flow improved to $88 million in Q2, and free cash flow was $24 million. Cash reserves are $2.9 billion. Returns and debt ROIC negative. ROE TTM, minus 26.42%. Total debt. Equity is 202.57%, though cash covers short-term obligations. Table. Key financial metrics. TTM Q2 2025. Metric. Value assessment revenue growth, YoY, 9% Q2. Moderate net income $263 million, Q2 poor. Free cash flow $24 million Q2, improving debt. Equity 202.57%, high leverage. TTM minus 26.42%, very poor. 4. Intrinsic value estimation. Discounted cash flow DCF analysis challenges. Negative earnings and unpredictable FCF make DCF unreliable. Base case assumptions. Revenue growth, 10% annually next 5 years. FCF margin, stabilizing at 5% by 2030. Discount rate, 12% high risk. Estimate. Intrinsic value, $6 到8 share. Below the current $8.16. Relative valuation, PS ratio, 2.43 TTM versus industry average, approximately 5-6x. Potentially undervalued but justified by losses. Analyst targets, average one-year target $9.26, suggesting modest upside. Verdict: overvalued based on earnings power, but fairly valued relative to growth potential. 5. Long-term prospects opportunities. AR glasses launch. Specs 2026 could open new revenue streams. Snapchat Plus growth. Subscribers approximately 16 million, growing 42% YoY. AI advertising tools. Sponsored snaps and AI bidding improvements drive advertiser ROI. Risks competition. Intense pressure from Meta, TikTok, and YouTube. Profitability. No clear path to sustained profits. Regulation, privacy changes, and FTC scrutiny could impact ad targeting. Debt. High leverage limits financial flexibility. Outlook. Uncertain. Growth initiatives are promising, but profitability risks remain. 6. Final verdict. Buffett-style suitability criterion assessment explanation. Understandable business, moderate social media. AR is comprehensible, but complex tech risks. Consistent earnings, poor persistent losses, unreliable profitability, good ROIC, very poor negative returns. Low debt, poor high debt, equity 202.57%, attractive valuation, fair PS, reasonable but no earning support, long-term moat, weak AR innovation is offset by competition, and low switching costs. Overall suitability, not recommended. Snap fails most buffet principles. No economic moat, inconsistent earnings, poor returns, and high debt. It may suit aggressive growth investors but is unsuitable for value-oriented portfolios. Disclaimer: this analysis is for educational purposes only and not financial advice. Consult a financial advisor before making investment decisions. Sources: Snap Inc., Financial Reports, Yahoo Finance, SEC filing.